Hello and welcome back to the channel. Today I'm going to be discussing what the most bought funds were of the 2023 financial year. I decided to make this video because I found that this data has been really useful for me to see where people are putting their money at the moment. And as share price is intrinsically linked to the number of shares that people buy, I found that it's given me a really good indication of what markets are likely to see the most growth in the future. I should point out that this data is based off of buying activity from ISA holders at the Interactive Investor trading platform. And whilst there is likely to be a little bit of variance from trading platform to trading platform, I've actually found that there's a lot of recurring themes, which I'll touch upon at the end of the video. Just, of course, remember to do all of your own research before investing, as this isn't financial advice. And without further ado, let's get started. So at number one on the list, we have Fundsmith Equity. The objective of this fund is to invest in equities from all over the world. And it takes a long-term approach to investing, so it doesn't try to look for any short-term wins. In the past couple of years, the performance of Fundsmith has actually fallen behind the growth of the MSCI World Index. But I think this is largely to do with the huge boom in share prices from the Magnificent Seven, which include Apple, Amazon, Alphabet, Meta Platforms, Microsoft, Nvidia, and Tesla. Essentially, it's been very difficult for funds like Fundsmith that haven't invested heavily in the Magnificent Seven to meet the benchmark of this global index. Despite this, Fundsmith has shown a really good annualized rate of return of 15.7% since its inception in 2010, and this actually outperforms the S&P 500, which shows an average annual return of around 10%, but that goes all the way back to 1957. And there have been a lot of financial experts saying that the Magnificent Seven is wildly overpriced at the moment, and that it's only a matter of time before there's a correction and the share prices come tumbling all the way back down. And this might explain why Fundsmith doesn't have a huge position in them. I also think that this is what makes Fundsmith unique amongst global trackers. The fact that they haven't got a huge position in the Magnificent Seven and they've still done so well is really impressive. It's definitely one that I'll be looking to add to my portfolio in the future. Another thing to point out here is that even though it's a global tracker, it's heavily weighted towards US stocks, which make up about 2/3 of its portfolio. But this is actually quite normal for global tracker funds, as the US makes up about 40% of the global market cap. In second place, we have the Vanguard Life Strategy 90% Index. This is a fund that invests 90% of its portfolio into equities, in other words, stocks and shares, and 10% into bonds. Once again, it's a global tracker, investing predominantly in global developed markets, but also some emerging economies as well. For those of you that don't really know what bonds are, they're not quite like stocks, but essentially you're loaning out your money to a company or a government who will pay you that money back on a specific date, plus interest, which is normally paid out twice a year. Generally, bonds aren't considered as sexy or as exciting as stocks and shares, as they don't typically rocket up like shares would, but they are considered a much more safe investment. So what you may sacrifice in capital growth, you make up for in security. In third, we have the L&G Global Technology Index Trust. The objective of this fund is to provide growth by investing in companies in the FTSE Global Index, which are specifically involved in IT. I think that the reason that this fund has been so popular is because the top 5 holdings are all companies in the Magnificent Seven, and it makes up over 50% of the portfolio. Because of this, the fund has seen some phenomenal returns over recent years, such as 50% in the last 12 months and 200% in the last 5 years. Whilst these returns may seem very appealing right now, as mentioned before, because these shares are so overpriced, a sudden correction just could cause the fund's share price to absolutely collapse. This is potentially why other funds like Fundsmith, who haven't invested in the Magnificent Seven so heavily, are more popular at the moment, because it allows investors to spread out their risk even more. I personally haven't got a huge appetite for risk when it comes to investing, so I'm currently sat on the fence with this one. Next up, we have the Royal London Short-Term Money Market. The fund's investment objective is to preserve capital and provide an income over rolling 12-month periods by investing at least 80% in cash and cash equivalents like bonds. It does this by providing a 4.17% yield, which is actually a little bit lower than the current interest rate of 5.25%, but of course the share price can increase too. This is very much an investment for the more secure investors out there, where you're pretty much guaranteed to get your money back, plus a nice little bit of interest on top. In fifth place, it's Jupiter India. If you're Googling what are the most promising emerging economies, you are guaranteed to see India pop up near the top of that list on any website that you check. This is for a number of reasons, including the continuous growth of their GDP of 6 to 7% per year, which is greater than many developed and emerging markets, introducing pro-growth economic policies like improving companies' ease of doing business, building better transport infrastructure, and having an expanding working age labour force. With regards to the Jupiter India Fund, it currently invests 96% of its portfolio into publicly traded Indian companies, with the remainder invested into developing Asian countries such as Pakistan, Sri Lanka, and Bangladesh. On top of this, according to Jefferies, which is a global investment bank, India's stock market is expected to double by the year 2030, surpassing economies like Germany and Japan by 2027. The industries it's invested in are pretty diverse as well, ranging from financials to consumer goods to industrials, and the average annual return over the last 5 years is just shy of 15%, which is fantastic. There are, of course, a number of India tracker funds to invest in, and personally I really like the way that my India tracker fund diversifies my portfolio. I also think we'll keep seeing really great things from India over the coming years, and hopefully even better returns. Next on the list is the Vanguard US Equity Index. This fund seeks to track the performance of the S&P Total Market Index. Unlike the S&P 500, which only invests in the top 500 or so largest cap stocks, this fund invests in small, mid and large cap stocks. For those of you that don't know, large cap stocks are defined as having a market capitalization value of $10 billion or more, and market capitalization is determined by the current share price times by the number of existing shares. In other words, this fund tracks the performance of the US economy. It's made up of 3,620 stocks, and it covers a range of industries, has a low management fee and pays a nice little dividend of 1.08%. It's done a great job of matching the S&P's total market index performance over the last few years, with an average annual return of 14.92%, which is actually really similar to the S&P 500. I think that the US stock market is going to just keep going from strength to strength over the foreseeable future. And whilst I don't have any position in this particular fund, I do have an S&P 500 tracker which I'm going to keep drip feeding my money into over time. Taking the 7th spot, it's the Vanguard Life Strategy 100% Equity. To put it simply, this is essentially a fund that is made up of 10 other funds. By the looks of things, I'd say that this is a pretty well-rounded fund with investments in a range of developed economies and emerging markets. It's also had a really good run over the last 5 years, returning an average of 10.15% and pays a dividend of 1.73% and has a pretty low management cost of 0.22%. I think if I wasn't already invested in a lot of these funds individually already, I'd probably consider adding something like this to my portfolio. 8th is the Vanguard FTSE Global All Cap Index. That is a mouthful. This fund is pretty similar to the last one in the sense that it's a global tracker, but instead of investing into other funds, it just invests into individual companies. It aims to track the performance of the FTSE Global All Cap Index by investing in a range of small, mid and large cap companies in globally developed countries as well as emerging markets. Capital growth performance has been a little bit better compared to the Vanguard Life Strategy 100% Equity, but the dividend yield is a little bit lower at 1.58%. To be honest, I think that if you're looking for a well-rounded global fund, you can't go far wrong with investing in either of these two funds. That being said, it doesn't have to be these two. I think any global tracker is a pretty solid addition to anyone's stocks and shares portfolio. Number 9 is the Vanguard FTSE Developed World ex UK. This fund aims to track the performance of the FTSE Developed ex UK Index, in other words, all developed nations except for the UK. That being said, it's heavily weighted towards North America, with nearly 3/4 of the portfolio being either the US or Canada. But this ex-UK fund made me realise that there aren't actually any UK-only funds on this top 10 list. And when I looked at the regional holdings of these global funds more carefully, it turns out that the UK typically only makes up a very small part of their portfolio. For example, Fundsmith Equity has less than 5% of its portfolio in the UK. The L&G Global Technology Index Trust has only 0.13% of its portfolio in UK equities. And the Vanguard FTSE Global All Cap Index has only 3.47% of its position in UK stocks. And this got me thinking, why don't people want to invest in the UK? It could be something to do with the fact that the UK stock market hasn't performed as well as US or global funds over recent years. It's also potentially something to do with the fact that the UK only makes up 4% of the global stock market. Or perhaps it's just got something to do with the fact that people don't have much faith in the UK over the next 10 to 20 years. But perhaps not investing in the UK is actually a good thing, as this fund has actually made an average annual return of 13.3% over the last 5 years, versus an average return of just 5.2% for the FTSE UK All Share Index and 5.6% for the FTSE 100. I do actually currently hold quite a large position in the FTSE 100, but after seeing this, it's made me think maybe I should be diverting those shares into US or global funds instead. Certainly one to think about. And to finish off, we have the HSBC FTSE All World Index, which is another global tracker that does a little bit of everything. So what this data is telling me is that the majority of people are either investing in funds related to the US economy or the whole world economy. And not only were US ETFs hugely popular, but you've got to remember that even with global trackers, the US part of it made up such a huge part of their portfolio, especially if those funds included the Magnificent Seven. As mentioned at the start of the video, this data was taken from ISA holders from the Interactive Investor trading platform, so results are likely to vary a little bit from platform to platform, so just take that with a pinch of salt. That being said, looking at the most bought ETFs on platforms such as AJ Bell, we actually see a very similar story in that pretty much everyone is either buying a US tracker or a global tracker. The only difference here is that we do actually see a little bit of investment in the UK market, as well as some investment into gold too. Again, take this with a pinch of salt, as this is only data from the last month with AJ Bell. So to summarise, it doesn't look like you can go far wrong with either investing in a US stock market fund or a global ETF. Emerging markets like India are also looking increasingly popular, and if you wanted to minimise your risk even more, you could consider investing in funds that invest in cash or cash equivalents. I personally hold a couple of my own. If you found this video interesting or helpful, I'd really appreciate it if you could like the video and subscribe if you aren't already, as I'll be making more videos like this in the future. And it also helps other people that are interested in this topic find the video too. I'd also love to hear your thoughts on my analysis of these ETFs in the comments. Thanks for watching.